Welcome back to Iron Financial. We're the only place on the street that helps you forge a stronger portfolio by cutting right through the market weakness. Today, we are putting Greenbrier, ticker GBX, under a high-pressure microscope. Now, this stock didn't just stumble. It got absolutely leveled by a freight train after a disastrous earnings report. And you can see the market running for the hills. The numbers were so bad, they bring up a question that every single investor has to answer right now. Is this a company with a broken axle, something that's about to derail completely as the economy slows? Or is this a bedrock opportunity, forged in the fires of fear, just waiting for investors who have the steel to look past these ugly, ugly headlines? Let's get into it.
So, the catalyst for all this chaos, it's right here on your screen, the Q2 numbers. You had Wall Street, the consensus, modeling earnings per share of 90 cents. They were looking for about $685 million in revenue. That was the benchmark. That was the expectation. What Greenbrier actually delivered was a total gut punch to anybody holding this stock. Just 47 cents of earnings on $587 million in revenue. Look, this isn't a rounding error. This isn't a little miss. This is a complete and total decoupling from reality. Whoa, hold on a second. Let me process this. You're telling me it was a nearly 50% miss on the bottom line? A 50% miss? And they missed their revenue target by almost $100 million? I mean, in this environment where every analyst is already sweating, looking for any sign of economic weakness, how does a major industrial manufacturer get their own forecast that wrong? This isn't just a signal to investors, my friend. This is a 5-alarm fire bell blaring that something is fundamentally broken inside this company, or maybe even worse, that their customers are slamming on the brakes, hard and fast.
And that's exactly why we're here. We are going to deconstruct this entire situation, piece by piece, systematically. So here's our blueprint for today. First, we'll size up the derailment. That's the big miss itself. Then we move to the damage assessment. Where exactly did this failure come from? Third, we're investigating the cracks. Are we looking at temporary fractures, or is this a sign of some deep systemic rot? Fourth, and this is crucial, we're checking the foundation to find the hidden strengths the market is totally ignoring right now. Fifth, we'll analyze the new blueprint. What is management's plan to get out of this mess? And finally, of course, we will deliver the iron financial verdict. Okay, let's get right into section 1, the derailment. We're going to focus on the immediate, shocking, headline-grabbing numbers that sent this stock tumbling more than 15% in a single trading session. This is the raw data that made algorithms and institutional trading desks just hit the sell button first and decide to ask questions later. So here's our first piece of hard evidence. The earnings per share surprise, a negative 47.78%. Let me put that in simple terms for you. They earned less than half of what every single analyst paid to follow this company expected them to earn. For a mature industrial company like Greenbrier, that kind of a miss is it's shocking. It completely blows up every financial model on the street, and it points to a major, major operational breakdown sometime during the quarter. Next up, the top line. A revenue miss of almost $98 million. This isn't just about how profitable they were. This shows a core problem with generating business, with actual demand. They just didn't sell or deliver what the market, and you have to assume they themselves, thought they would. In an economy that's so sensitive to interest rates, where these huge capital expenditures are being scrutinized, well, this suggests their customers are getting really nervous. The sales engine just completely stalled out. And this is the number that really paints the picture of the collapse in their profitability. This isn't against what was expected, this is against their own performance from last year. Year over year, net earnings didn't just dip, they plummeted by over 71%. Folks, this is not a cyclical dip. This is a catastrophic drop. So the real question becomes, what on earth could cause such a violent compression in profitability in just 12 months? Now, here's what's so powerful about this slide. It puts all the pieces of this disaster together in one place, side by side. Just look at the comparison. In Q2 of last year, they posted strong revenue, $762 million. This year, $587 million. Net earnings went from a very respectable $52 million all the way down to just $15 million. And diluted EPS, it fell from $1.56 down to 47 cents. Every single key metric moved violently in the wrong direction.
You know, this isn't a crack in the armor. This is a crater. A 23% drop in revenue and a 71% collapse in net earnings. You can't just wave your hand and explain that away with market softness. No way. That's the sign of a business hitting a brick wall at full speed. This is the kind of report that makes you question everything. Is this a Greenbrier-specific problem, or is this company the canary in the coal mine for the entire industrial and freight sector?
All right, that leads us right into Section 2, the damage assessment. We've seen the aftermath, we've seen the wreckage. Now we need to get to the scene of the crash and pinpoint the primary point of failure. We're shifting from the what happened to the absolutely critical why. What part of this business broke so badly?
And this slide illustrates the source perfectly. The problem is squarely, and I mean almost entirely, in their manufacturing segment. This is their bread and butter, their core business of building new railcars. Revenue dropped 24%, which is bad enough. But look at this. Railcar deliveries fell by a staggering 32% year over year, from 5,000 units down to 3,400. But the most critical number here, the one that absolutely destroyed the bottom line, is the margin. Manufacturing margin was literally cut in half, from a healthy 15% down to just 7.6%. That right there is the epicenter of the earnings earthquake. So what does management have to say about this demolition job? Well, on their earnings call, they laid out a whole list of reasons. They claim some deliveries are just shifting into next year. They had an unfavorable product mix. They said lower production volume hurt their fixed cost absorption. There was a planned holiday shutdown. And, oh yeah, customers are taking longer to place orders.
Is that what they're saying? Really? Because to me, this reads like a greatest hits album of corporate excuses. Timing of deliveries, isn't that just a nice code word for our customers delayed or maybe even canceled their orders? Unfavorable mix, couldn't that mean we couldn't sell any of our high-margin products? A holiday shutdown is planned. It shouldn't be a surprise that impacts your results. And my favorite, longer customer decision-making cycles, that is just a fancy boardroom way of saying demand is drying up in this high-rate environment. Are these real, unavoidable headwinds, or is this just corporate speak for a massive failure in execution and forecasting?
And that whole timing excuse, it just completely falls apart when you look at this number. Their railcar backlog is 15,200 units. Now, to put that in perspective for you, the last time it was this low was over a decade ago, all the way back in 2014. If underlying demand was still strong, and this was just a simple timing issue, you would expect to see a robust backlog of future orders. This number suggests the pipeline of future work isn't just thin, it's drying up. This might not be a temporary one-quarter problem. This could be the very beginning of a long cyclical downturn for their core business.
And that brings us right to the heart of our investigation here. In Section 3, Investigating the Cracks, the market skeptic sees a decade-low backlog and collapsing margins, and he sees clear signs of deep decay. Management, on the other hand, is trying to tell us a very different story. The crucial point for any investor right now is figuring out which one of these narratives is actually grounded in reality.
And here is that counter-narrative, directly from CEO Lori Tekorius on the earnings call. She's acknowledging the weak environment, yes, but she's arguing that comparing today's Greenbrier to the company it was a decade ago is a huge mistake. Her argument is that they have a much more flexible cost structure and a more durable, diversified business model now. They believe they have built this company to withstand this exact kind of pressure.
Look, with all due respect to the CEO, saying you're fundamentally stronger right after you report a 71% drop in net earnings and slash your guidance, that requires a massive leap of faith from investors. The numbers we've seen on the screen so far tell a story of profound weakness, not strength. Talk is cheap. They need to show us the structural steel that backs up a claim like that. Where's the evidence?
And that is exactly what we are going to do in Section 4, checking the foundation. The market is obsessed with the cracks in the manufacturing division, and listen, for good reason. But if we can look past the rubble of that income statement and actually check the company's real financial foundation, a very different picture starts to emerge. There just might be some serious pillars of strength hidden underneath all this surface damage. Okay, let's really dive into this, because this is so critical. The first pillar of strength is cash flow. While their net earnings were a measly $15 million, the company actually generated a massive $159 million in cash from its operations in the same quarter. You have to remember, earnings are an opinion, but cash is a fact. The crucial point here is that even with their accounting profits under immense pressure, the core business operations are still a powerful cash-generating machine. This is a critical distinction that the market is completely overlooking. And that powerful cash flow leads directly to this, a war chest of over $1 billion in total available liquidity. That's made up of cash on hand and undrawn credit lines. This is the highest level of liquidity in the company's entire history.
So this is not a company that's struggling to make payroll. This is a company with immense financial flexibility to navigate a downturn, to invest opportunistically, and to return capital to its shareholders. This is what financial bedrock looks like.
But can cash really save a company whose primary business is shrinking? I mean, $1 billion is an impressive safety net for sure, but it doesn't solve the demand problem in manufacturing. It buys you time. Okay, I'll grant you that. But time to do what? If your main revenue engine is broken and your backlog is shrinking, all the cash in the world just means you're going to bleed out a little bit slower.
That is a fair challenge. And the answer, I think, lies right here in this chart. We have to stop thinking of Greenbrier as just a cyclical manufacturer. This is really a tale of two different segments. Yes, manufacturing is the giant, the big kahuna, bringing in $541 million in revenue this quarter. But look at that other piece, leasing and fleet management. It's much smaller, sure, at $46 million, but its characteristics are completely different. While manufacturing is volatile, it's cyclical, it's totally dependent on the economic climate, leasing is stable, it's contractual, and it's recurring. And this slide brilliantly illustrates why that smaller segment is so unbelievably important. This is the steel reinforcement running through the company's foundation. Fleet utilization is at a near perfect 98%. The margin is an incredible 61.7%. Now, compare that to the 7.6% margin we saw in manufacturing this quarter. And while the manufacturing segment's earnings were collapsing, this division's earnings from operations actually grew 2.6% year over year. This is a high-quality, predictable, growing cash flow stream that provides a vital ballast against the storm in manufacturing. This is the fundamentally stronger business the CEO was talking about. So what does management do when they're faced with a total collapse in their manufacturing business? They take that strong cash flow and that leasing stability, and they signal extreme confidence. They announced a 6% dividend increase. Now, you have to stop and ask yourself, what kind of company, a company that's supposedly on the verge of a structural collapse, actively chooses to send more cash out the door to its shareholders? This is a powerful, tangible signal from the board that they believe the underlying foundation is not just stable, but strong enough to support a higher payout for years to come. Okay, so let's move on and see how this all builds into Section 5, the new blueprint. A dividend hike is a statement, for sure, but we need to see the full plan. Let's analyze management's updated guidance and their strategic response to really understand how they plan to navigate this environment and rebuild for the future. Well, if we're talking about the new blueprint, this is page 1, and it is covered in red ink. This is a major red flag. They took an axe to their full-year guidance. The old EPS range was nearly $4 to $5 a share. The new range is $3 to $3.50. You realize what that means? The high end of their new guidance is lower than the low end of their old guidance. That is a capitulation. And revenue? The new midpoint of $2.45 billion is miles below the prior consensus of almost $2.9 billion. This proves the weakness isn't contained to one bad quarter. They are telling the market, loud and clear, to expect the pain to continue for the rest of the fiscal year. That confident dividend hike looks a whole lot less confident now, doesn't it? I see it differently. I don't see panic here. I see a proactive, strategic response. 1, they're moderating their production rates to align with the new demand reality. That's disciplined, that's not desperate. 2, and this is the absolute key, they are leaning into their strength. They are jacking up the capital expenditure for their lease fleet to $300 million to aggressively grow that stable, high-margin, recurring revenue stream. 3, they're managing costs. They're targeting a $30 million reduction in administrative expenses. And 4, yes, even with the guidance cut, they are confident enough in their cash generation to continue returning capital through dividends and buybacks. This is not a company that's lost. This is a company making deliberate, tough adjustments to a tougher macro environment. All right, that brings us to the final section, the iron financial verdict. We have laid out all of the evidence, the ugly headline miss, the collapsing manufacturing business, the weakening backlog, but also the powerful cash flow, the fortress balance sheet, and that stable leasing division. It is time to weigh it all and determine if this is an opportunity in the wreckage or a structural trap for investors. Look, the bear case is simple and it is brutal. You have a massive miss on both earnings and revenue that really calls management's credibility into question. You have a backlog at its lowest point in over 10 years, which signals future weakness. You have a drastic guidance cut that confirms more pain is on the way. And at the very core of it all, you have the company's biggest segment, manufacturing, with margins that have been completely and utterly obliterated. This looks like, smells like, and feels like a classic value trap. The bull case, however, looks beyond the income statement. It is built on the foundation of powerful cash flow generation that persists even when things get tough. It's supported by a fortress balance sheet with record liquidity of over $1 billion.
It's stabilized by a high-margin, recurring revenue leasing business that is growing and being invested in heavily. And it's validated by a management team that is confident enough to raise the dividend right in the face of all this negativity. The bull case is simply that the market is selling the cyclical story while completely ignoring the stronger, more durable company that's being built underneath.
So here it is, the iron financial verdict. The market is absolutely right to be concerned. The headline numbers are ugly. The manufacturing business faces a very, very tough road ahead in this economic cycle. This is going to be a heavy lift for the company to execute its turnaround. However, the violent sell-off is ignoring the immense underlying financial strength, the powerful cash flow, the record liquidity, and the stabilizing force of that high-margin leasing business provide a foundation that is, in our view, undeniably solid. The company is built to withstand this cycle, and for long-term investors who have the stomach for volatility, the current fear may just be creating a bedrock opportunity.
Which leaves us with one final, provocative question for you to think about. Is the market's brutal reaction here just an overreaction to a predictable cyclical downturn in a tough industry? Or, with persistent inflation and higher for longer interest rates, are we actually seeing the beginning of a new, harsher reality for industrial manufacturing as a whole? The answer to that question will determine whether stocks like Greenbrier are traps or treasures. Continue to do your own research, cut through the noise, and keep forging a stronger financial future. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.